Hello everyone. In this recording and this video lecture, I'm going to be covering macroeconomic analysis in our set of notes here that goes until we talk about business cycles. So macroeconomic and industry analysis, security selection and analysis is generally approached from a top-down approach, finding the intrinsic value of an equity. So when we talk about intrinsic value, what we're talking about is the value of the firm based on its expected future cash flows. Is often achieved through fundamental analysis. Fundamental analysis is the examination of the sources of cash flows of the firm and the riskiness of those cash flows. The firm's cash flows are determined by the global economic environment, economic factors affecting the firm's industry, and the position of the firm within its industry. There is a lot of stuff going on in the world right now. I'm recording this on March 18th. And 2 days ago, the Federal Reserve cut interest rates again, and now the targeted Fed funds rate, we're going to talk more about this later, but the targeted Fed funds rate is between 0 and 0.25%. The Federal Reserve has pushed more money out into the economy, and also the government is starting to talk about some fiscal programs that we're going to talk about later on in this section. So I'll be bringing those things into this lecture. But we're going to start off with the global economy. Opportunities can arise in international markets based on the state of foreign economies. And so what are some examples of expanding economies and contracting economies? And these have actually changed some in the past few years. I tried to find a good article on this. And one I found from The Economist, it is from 2018. We can see here that the worst performing economies 2 years ago were Venezuela, Puerto Rico, and they had some pretty devastating natural disasters. Equatorial Guinea, North Korea, and then Brunei. And Brunei was actually growing a tiny bit at that point. And then we can see, that the best performing growing economy was Dominica, and then India, Bhutan, Anguilla, and Ethiopia. The U.S. is closer to the lower end, and the economy here was growing a little less fast than the rest of the world on average. This is ranked based on the GDP forecast for the year and the change from the previous year. So to answer the question in our notes, here we go. What are some examples of expanding economies? Well, like I said, Vietnam, India, Dominica. Those are all examples of expanding economies. Some contracting economies are Venezuela, Puerto Rico, and Puerto Rico, may have changed a little bit since then, although they're still having a really difficult time. So Venezuela, Puerto Rico, North Korea. The more industrialized, more modernized countries, we see really right here in the middle and kind of on the lower end, France, Germany, United States, Canada. The ones up here towards the higher end of growth tend to be, in general, a little less modernized. They're going through that modernization process, and that's what's allowing for them to have these high growth levels. As economies become more stable, they're going to tend to go down. Still have decent growth, positive growth, but their growth is going to be slower, and that's kind of what we also see with businesses. When a business is still developing, when it's It's kind of young still and still growing. It has room to grow. As an economy becomes more established, the growth slows down because the room for growth, the capacity for growth, just isn't there anymore. Exchange rates, changing exchange rates affect the ability of companies to make profitable sales overseas. So whenever the exchange rate risk is the risk that fluctuating relative values of currencies will negatively impact sales and profits of a firm. So from Investopedia, we're going to talk a little bit about what a weak dollar and what a strong dollar is. A weak dollar is a situation where the US dollar's value is decreasing relative to one or a basket of foreign currencies. Essentially, a weak dollar means that a US dollar can exchange for fewer amounts of the foreign currency. Depending on the type of transaction that a party is participating in, possessing a weak dollar is not necessarily a bad situation. For example, a weak dollar may be bad news for U.S. citizens wishing to vacation in foreign countries, but it could be good news for U.S. tourist attractions, as it also means that U.S. would be more inviting as a destination for foreign vacationers. So right now, what's going on with the Federal Reserve putting more money out into the economy, they're trying to encourage economic growth, and the kind of the net effect, if we ignore what other countries are doing right now, if other countries weren't doing anything, the effect of this would be to weaken the U.S. dollar, because the Federal Reserve is buying up treasuries, U.S. treasuries, so they're putting cash out into the marketplace. They're increasing the amount of cash, and we know with supply and demand, as we increase the supply of something, the value of it goes down. As we increase the supply relative to demand, the value goes down. And so the Federal Reserve pushing dollars out into the economy lowers interest rates. It also creates a weak dollar, which again is good if we want foreign countries to purchase U.S. goods, to kind of encourage exportation of U.S. goods. A strong dollar is a dollar that can be exchanged for a large or increasing amount of foreign currency. The strength of the dollar has an impact on imports and exports because goods and services from a foreign country are usually purchased in the currency of the producing nation. For example, if the dollar were strong, one would expect imports to be high and exports to be low, because the dollar will buy a lot in a different country while it is expensive to purchase dollars with outside currencies. Alternatively, with a weak dollar, one would expect high exports and low imports. So again, who benefits from a strong dollar? Importers benefit from a strong dollar. Because they can buy more internationally produced goods with US dollars. Who benefits from a weak dollar? An exporter. Well, let me say exporters and U.S. tourism. Again, because what happens there is it makes it cheaper for, or less expensive for, people overseas to come to the U.S. to visit the U.S. because relatively our stuff is cheap. It makes it easier for people to export things because, again, relatively, U.S. Goods produced in the U.S. when we have a weak dollar are cheaper for people internationally. So by creating a weaker dollar, one effect, or one desired effect, is that U.S. exporters will be able to sell more overseas as a result of that. The domestic macroeconomy, returns for stocks generally trend with earnings for the firms in the marketplace. PE ratios can be indicators of overvaluation, but are sensitive to low earnings per share. So let me translate that a little bit. If the expectations were always constant for firms, we would expect to see the price to earnings ratio remain relatively stable over time. So we're willing, what that means is that investors are willing to pay a certain multiple of today's earnings for the future earnings and cash flows of a company. We can see here that there's certainly some bumps in our PE. This is our S&P 500 PE ratio for the S&P 500. We see a bump here in the early 2000s. Then we see a bigger bump here in 2009 and 2010, and this is because of a recession, this first one, and the second one is because of the financial crisis. So what was happening here was that earnings fell dramatically for firms during these times, and even though stock prices also fell, the net effect was that the stock prices didn't fall as much as earnings, and so we saw a big bump in this PE ratio during those time periods. A high PE can be an indicator of an overvalued stock. So these are the historic PE ratios and stock prices of Microsoft. So what we see here, and I wanted to include this time here in the late 1990s because that's where we saw the internet and kind of the tech bubble bust. And so what we see here leading up to that tech bubble busting is, in the red here, is the price to earnings per share, and then the black line, dashed line, is the share pricing for Microsoft. We saw the PE ratio get really high here. We're looking at about 85, so the price was 85 times earnings, which is quite high. And that's where you can see here, we get into 1999, and this is the bubble bust, where the price to earnings ratio goes down dramatically. Then we get out here in 2018 for this company. We're going to take a look at this here, but the reason why it went up, price to earnings went up here in 2018, was that the earnings per share of Microsoft fell, but the price didn't fall along with it. And that's probably because investors expected that was a transitory issue with the earnings per share for Microsoft stock. But we can also see, for Microsoft stock. And so here's the earnings per share for Microsoft. We can see here there's a little dip during a recessionary period. They actually weathered this financial crisis pretty well. We see a little dip here, but it's not too bad. There's a dip in earnings per share in 2015 and 2016, and then in 2018 and 2019. But overall, the market just saw these as transitory. They didn't expect this dip in earnings per share to last a long time, and so we see that's where the stock price, this black line, kept trending upwards during that time, although the price to earnings ratio increased dramatically. So in general, what to take away from that is that, again, the items up here, that price to earnings ratios can be indicators of overvaluation. So if you see the price to earnings ratio for a firm, or what a lot of investors look at is the price to earnings ratio for the S&P 500. So right here, although it may not look like much, we did see some upward trending in this price to earnings number. 2018, the stock market as a whole dropped. We had a negative return for 2018 for the S&P 500 and for the major indexes. And that's reflected here in the price to earnings ratio, but really it kind of got back down to a normal amount, a normal PE of a little over 17 at the end of that drop in 2018. So you could say that the market was overvalued in this period here, 2015, 16 through beginning of 2018. So some key variables. The gross domestic product is a measure of the economy's total production of goods and services. A rapidly growing GDP Oh, sorry, that's wrong. I shouldn't say is indicates. It should just say indicates. An expanding economy with opportunity for firms to increase sales. Another key variable is employment. The unemployment rate is the percentage of the total labor force yet to find work. The unemployment rate measures the extent to which the economy is operating at full capacity. Another indicator is the capacity utilization rate, which is the ratio of actual output from factories to potential output. So what I've got down here is from the Bureau of Labor Statistics, what are the concepts of employment and unemployment. And there's some confusion around this because, you know, prior to what's going on in the world today going on, our unemployment rate in the U.S. was 3.5%, which is incredibly low. During the 1970s and early 1980s, economists said the lowest unemployment can get is 5%. They said that was really just structural unemployment. There's a certain percent of the population that wants to work that just can't, or they're literally in between jobs, where they've quit one job and they're expecting, or they've been accepted for a new job, but it hasn't started yet. So there's just this, portion of the workforce that's always going to be out of work. Not necessarily the same people. However, right now we're below that number, or we were just a few weeks ago. So what are the basic concepts of employment and unemployment? The basic concepts involved in identifying the employed and unemployed are quite simple. People with jobs are employed. People who are jobless, looking for a job, and available to work. So those are the three key things. People who don't have jobs, which kind of makes sense, they also have to be looking for a job and available for work. Okay? So, for example, my wife, she doesn't have a job where she goes to work and gets a paycheck, but she stays at home, takes care of my son and my daughter, so she's not looking for a job and she's not available for work. So while she is jobless, she's not counted as unemployed. The labor force is made up of employed and the unemployed. People who are neither employed nor unemployed are not in the labor force. So people like my wife, people like my parents, they're both retired. They are not employed, nor are they unemployed. They're just not part of the labor force. So the question I have here is, how can too low of an unemployment rate not be good for the future of an economy? Well, it can actually be bad in a couple of different ways. Although we tend to like to see really low unemployment rates, that means everyone has a job. Hopefully they're generating enough income to get by on. But there's some problems with having too low of an unemployment rate. First of all, going back to this idea of supply and demand, we have a situation where that labor is our good, and the demand for labor is higher than the supply, and so as a result, labor costs increase. Secondly, and we've seen this as in certain areas of the country especially in certain fields, that there is insufficient labor available to put capital to work. In other words, we might have factories that sit idle because there's not people to work in them. Or there might be demand for products and services out there that aren't being met because we don't have people to provide them. And so that can actually be a little bit of a drag on an economy. So having some people out there that are actively looking for work, maybe that they're unemployed and they're looking for work, is actually a good thing for a healthy economy, because they're available to fill needs as they come about. If you're paying much attention to the news, you might see right now that, while there's fear that a lot of people are going to be unemployed, there's predictions of a 20% unemployment rate as people are asked not to go into work, as people are asked not to go and go to restaurants or bars, that the people that normally work at those places will be out of work. On the other hand, You have places like grocery stores begging for people to come in and work because they need more people to fulfill the demand. You've got Amazon out there actively working for trying to find people to work in their warehouses because of the high demand for people that are just buying off everything through their computer and having it shipped to their home. So having people available to work will hopefully allow those grocery stores and places like Amazon to fulfill those needs for workers in the workforce. Another variable that's important is inflation, and that's the rate at which the general level of prices rise. High rates of inflation are associated with economies where the demand for goods and services outstrips their productive capacity, which puts upward pressure on prices. The number one example of that right now is Venezuela. You saw that they are probably the slowest growing economy, and one of the problems is rapid and massive inflation. And what's happened in that case is that the government has been generating cash. They've been printing out cash to the extent, and they've been doing this to kind of pay the bills for the country, but they've been doing it to such an extent that it's created this massive level of inflation for the country. So when currency is produced far in excess of the demand for the currency, this results in high inflation. We saw the same thing with Zimbabwe in the last 15 years or so. I somewhere, and I don't know where it is right now, but I somewhere have a $10 trillion Zimbabwean bill, because that's how much currency they were generating, and how high the rate of inflation was, that people would get paid twice a day. And so, because at the end of the day, the money they earned in the morning was worth much less than it was when they earned it. Another variable is interest rates. Interest rates can affect the growth of an economy, especially the sale of high-priced consumer durables. So, this is something that we're facing right now. And we're going to talk more about this a little bit later, but the Federal Reserve is trying to lower rates, is working on lowering rates, and the goal of that is to encourage economic activity. So what effects do low rates have on an economy? Well, on the plus side, it lowers the cost of borrowing, they lower the cost of borrowing, which encourages investing in capital and consumer purchases of large items. So whenever rates get really low, you'll start to see, and we're even seeing this now, where car dealerships start offering zero interest loans for vehicles. Mortgage rates get really low, encouraging people to buy houses, or maybe to upgrade their house, or buy a bigger house. Companies see this cheap money, and they'll go out and borrow money to purchase equipment and facilities, and that hopefully encourages economic activity. And so that's the upside to lower interest rates. On the other side, of the downside, is that this also results in lower returns for people who are invested in safe investments. Sorry, let me add one more thing there. For people and institutions. So retirees are more likely to invest in things like certificates of deposits and corporate bonds and government bonds. But as a result of low interest rates, those investments don't generate much return, and so they live on that return. That's what they count on for purchasing the things that they need. And so as a result, we've had as a result of very low interest rates for the last 10 years, and it's not a situation which doesn't appear to be changing in the near future. Institutions like pension funds and foundations and endowment funds that might go for a little less risk, especially those pension funds, retirees who are looking to stabilize their income and stabilize the value of their investments, and so they can count on income every month coming in. They're getting hurt by this because they are kind of either have to choose between taking on a lot of risk or going safe, but going safe means that they're going to earn very little return as a result of low interest rates. So what effects do high rates have on an economy? High rates decrease investment and consumer purchasing of large items. So really anything that has to be financed, it's less likely that's going to happen. In the early 1980s, we saw mortgage rates in the 15-16% rate, which really hurt the housing markets because nobody wanted to go out and buy a house and finance it with debt that would cost them 15% a year. And so that really hurt the housing market and purchases of those things. It hurt the sale of cars because, again, people would finance those cars, and at really high rates that made the cars very expensive. However, on the other hand, it does help investors who are invested in safe securities. And again, these are going to be things like your treasury stock, or sorry about that, your treasury bonds, your treasury bills, your certificates of deposit, because they're going to be offering much higher rates. So what happens to the stock market? In general, when rates are lowered, the prices in the stock market increase. Because again, it spurs investment, and also it lowers the interest that companies are going to have to pay on their debt. So that leaves more cash left over for investors to receive. High rates generally have the effect of lowering stock prices. Sorry, let me change that. Increasing rates. And so this is why politicians go out and they really want the Fed to lower rates, because when rates go down, stock prices go up. That makes people's 401ks bigger. That makes people happier, and they, politicians that are currently in office want people to be happy, so they continue to vote for them. You might ask them, why don't they just lower rates all the time and keep them low? Well, that can lead to massive inflation, because that's often the result of open market operations, which we'll talk a little bit more later about, and that's just pushing cash out into the economy. And also, it does hurt your institutions and your retirees that count on making return on safe investments. The budget deficit is also another important variable when we talk about the domestic macroeconomy. The budget deficit for a government is the difference between government spending and revenues. If spending is higher than revenues, then we have a deficit. If spending is less than revenues, we have a surplus. Borrowing to pay for deficits can increase interest rates and slow down the economy. So one thing to keep in mind here, because I hear people confuse these two concepts quite a bit, is the difference between the budget deficit and the debt for the government. So deficit is the difference between the revenues and expenses if expenses are higher than revenues. It's a surplus the other way. The debt is the accumulated deficits and surpluses. Sorry, just be the accumulated deficits less surpluses. So, if you want to know how we got to, and I think right now it's 22 or 23 trillion dollars of debt, it's the accumulation of all the past deficits that the government has generated. And occasionally we'll get a surplus. The last surplus we had, the last time our budget was balanced, so not really much of a surplus there, was in the late 1990s. There was one year when we did have a balanced budget with the U.S. government. The next variable is sentiment. Consumers and producers' optimism concerning the economy is an important determinant of economic performance. If people feel happy about the world, if they feel good about the future, they're going to go out and spend money. They're going to go out and invest. If people are pessimistic about the future, they're going to seek more safety. They're going to put their money in a savings account or a checking account or a very safe investment. They feel that things are volatile and the prices can't be trusted, and the future really isn't very predictable. So demand and supply shocks. A demand shock is an event that affects the demand for goods and services in the economy. Examples are reductions in tax rates, increases in the money supply, increases in government spending, etc. We could say now, right now, is that the situation with the coronavirus and really that combined with the government really pushing people to stay home, don't go out, certainly don't go out with people in groups, don't go to classes, don't go to school. That is also a demand shock, because people, if they're staying at home, unless they're out, on Amazon or other, your other internet, shopping experience there, they're probably not spending as much money. And as a result, demand is reduced, and especially if they feel like, and we're going to get into supply shocks here in a minute, but if they feel like their job is in jeopardy, okay, they're not going to be out trying to purchase more things. And so as a result, that's a demand shock. Our current health situation, coronavirus situation, would also follow the definition of a demand shock, because demand shocks are usually characterized by aggregate output moving in the same direction as interest rates and inflation. Not going to really touch on inflation, but certainly we have interest rates falling. We also have the demand for products and services probably falling other than, for things like toilet paper. There seems to be a lot of demand for that. A supply shock is an event that influences production capacity and cost. Examples of supply shocks include changes in the price of imported oil, weather changes that may affect crops, changes in labor rates, etc. Supply shocks are usually characterized by aggregate output moving in the opposite direction of inflation and interest rates. And so, you might notice all of the things here are things that are kind of external, and they impact the cost of doing business, or the ability to produce goods and services. So an increase in the price of oil will increase the cost of providing a lot of goods and services, because we have to transport things. Weather changes. So let's say we are hit with a drought. The ability to produce crops is decreased, but it's not because of something the farmers are doing. It's because of the weather. These are external things that generally impact the ability to produce goods and services. So I've got an example here. In 2008, the U.S. government sent out a tax rebate stimulus check. And by the way, this is something the government is considering doing right now. At that time, you received $300 for every member of your household. You literally got a check in the mail for $300 for every member of your household. At that time, I had 4 members, still do, in my household. And so we received a check for $1,200. So was this a demand shock or a supply shock? In this case, it would have been a demand shock because the goal was to get people to increase demand, to go out and spend the money. In fact, that was the instructions. We're sending you this money. Go out and buy stuff. And unfortunately, a lot of people didn't do that. They used it to pay off their credit cards, or they used it to stick in the bank. And so the desired economic activity that came out of that really didn't materialize. So was this a demand shock or a supply shock? It was a demand shock. The goal of the program was to increase the demands for goods and services by providing liquidity to consumers. In other words, let's give consumers cash and they'll go out and spend it. The next topic is federal government policy. So we're going to talk about demand side policies, which include fiscal policy and monetary policy, and then supply side policies, which generally focus a lot on tax policy. So let's start off with demand side policies. Again, the goal of demand side policies is to encourage demand from consumers, so that encourages investment. So the demand for a supplier, the demand for a good or service pushes up the price, and so as a result, people or companies go out and produce more to take advantage of that higher level of demand. And so that's kind of how demand side policy works. The approach from the government is through fiscal policy, the government spending and taxing actions, and monetary policy. It's kind of a hard word for it, but manipulation of the money supply, increasing and decreasing the supply of money to affect, in general, interest rates. So fiscal policy is the most direct way to stimulate or slow the economy. Formulation of fiscal policy is often a slow, cumbersome political process. To summarize the net effect of fiscal policy, look at the budget surplus or deficit. And the idea behind fiscal policy is that the deficit stimulates the economy because it increases the demands for goods via spending by more than it reduces the demands for goods via taxes. In other words, the government is spending more than it is taking in taxes, which creates a deficit. And that increases the demands for goods because when government spends money, it is either directly purchasing goods and services or sending money out to individuals or corporations with the goal that they will go out and increase demand for goods and services. So I'll just put a note in here. The current proposal to send checks to households is a fiscal policy. And I've heard different number amounts, $1,000 per household, $1,000 per adult in a household. And again, it's kind of like what happened in 2008. The government sends out essentially cash, although it's in the form of a check, to households with the goal that they're going to turn around, get that money and spend it somewhere else to encourage companies to, keep people, working, to keep people producing goods and services, and to kind of hold up the economy and hold it stable for a little bit. Monetary policy is the manipulation of the money supply to influence economic activity. Increasing the money supply lowers interest rates and stimulates the economy. It has a less immediate effect than fiscal policy, because that increase in the money supply, the lower interest rates, they have to kind of work themselves out through the system. So we lower interest rates, and then companies say, hey, it's a good time to go out and buy some new equipment because interest rates are so low. And so they go out and they buy that equipment, but that takes a lot longer, or they buy a new building. But that takes a lot longer to happen than sending someone a check and they turn around the next day or two or 3 days later and go out and spend it. So monetary policy takes a little bit longer time to have an effect. The tools of the monetary policy include open market operations, discount rates, the discount rate, Fed funds rate, and reserve requirements. I'm just going to make a little note. I believe I've talked about these before in class, but just a little note. Open market operations. When the Federal Reserve, and I'll refer to them from the Fed now on, purchases U.S. Treasuries. So what they're doing is they're taking their cash that they have and they're exchanging that cash with U.S. Treasuries. So they're essentially putting more cash out in the marketplace. This increases the money supply and decreases interest rates. Okay. The opposite is true when the Fed sells U.S. Treasuries, and they have trillions of dollars worth of U.S. Treasuries. This decreases the money supply and increases interest rates. And they do this, when the Fed does that, they do it in an attempt to manage inflation. So if they feel like there's going to be inflationary pressures, and they want to decrease that inflationary pressure, they'll go out and they'll sell U.S. Treasuries to pull liquidity out of the marketplace to manage inflation. Right now, what the Federal Reserve is doing is that they are buying U.S. Treasuries and putting cash out into the marketplace. So the last I heard, and again, this is changing day to day, but they just did another purchase of about $500 billion worth of U.S. Treasuries to, again, put more money out in the marketplace and lower rates and increase liquidity for banks. A discount rate. This is the rate that banks purchase, or another way to say it is borrow, money from the Federal Reserve. I won't type up the next little bit. I just want to give you an explanation of what's going on. So banks, in order to meet their reserve requirements, have to keep so much money on hand. And when that money is on hand is overnight. And so if they don't have enough money in their banks to meet their reserve requirement overnight, then they're going to go out and they're going to borrow money from someone else. And it's honestly, hopefully at least, just for the evening, okay, just for the night. And so the Fed manages the rate at which banks borrow and lend to each other by setting a discount rate. And so the Federal Reserve is the lender of last resort for banks. So if a bank is not going to meet their reserve requirements for the night, the bank will go out and try to borrow money from other banks. If they can't find any other banks to borrow from, then they go to the Fed funds discount, the Federal Reserve's discount window. Okay? And then they're going to, again, the Federal Reserve is the lender of last resort for these banks. And so they'll borrow money from the Federal Reserve, although the Federal Reserve really doesn't like that. But they set the rate so that it affects the Fed funds rate. So it's usually set about half a percentage higher than the targeted Fed funds rate. So it's a targeted Fed funds rate. The Federal Reserve doesn't actually set the rate at which banks borrow and lend to each other. They encourage it through that discount rate. They want banks to borrow and lend to each other, and so they charge a higher rate if you go to their discount window. So what happened actually 2 days ago is the Federal Reserve reset this targeted Fed funds rate, and they lowered it up 1%. Currently, the targeted Fed funds rate is really low. So targeted federal funds rate is between 0% and 0.25%. They decreased it 1% or 100 basis points. So that was dramatic decrease. It really can't go lower, although some people might say that it could become negative. That would be a very difficult thing to happen, because that would mean that banks are borrowing or are lending money to other banks at a negative interest rate. So that it'd be very unlikely for that to happen here in the U.S., although we've seen similar things in other countries that have slightly different systems. So the goal of decreasing that discount rate is to lower interest rates overall. It's hard to say really most, but I can definitely say many. Business loans are floating rate loans that are tied to what's called the Wall Street Journal WSJ prime rate. Which is the targeted Fed funds rate plus 3%. So if the targeted Fed funds rate is 0%, which technically what I've been told in the past is it can't actually be 0%. That's why we see a range of 0 to 0.25%. But if the targeted Fed funds rate were 0, then the Wall Street Journal prime rate would be 3%. I expect that the new Wall Street Journal prime rate is 3.25%, because when the range was between 1% and 1.25% for the targeted Fed funds rate, then the Wall Street Journal prime was 4.25%. But what happens, though, as a result of that rate, that index rate there, the Fed funds rate going down, is that it becomes cheaper for businesses to borrow, and it lowers the interest expense for businesses that are already borrowing using that floating rate. When I worked in commercial lending, most of our business loans were floating rate loans that were tied to the Fed funds rate. So that kind of covers demand side policies. Supply side policies. The goal of supply side policies is to create an environment in which workers and the owners of capital have the maximum incentive and ability to produce develop goods. Supply siders focus on how tax policy can be used to improve incentives to work and invest. So some examples of this are tax incentives to invest in capital purchases. For example, accelerated depreciation can be seen as a way to use tax policy to encourage investment. And so the way that it works is that whenever a company buys a depreciable asset, they get to recognize the cost, a large portion of the cost of that asset early on in the life of the asset, which reduces their tax liability during those years. And so that encourages, accelerated depreciation encourages companies to make capital expenditures in order to kind of grow the economy and grow economic activity. So that's it for this video. The next video is going to start with business cycles, and I'll talk to you soon.